Yes, well, we're expecting that 3 to 4 rate hikes for this year. Now, I think what the market is adapting to is a change in the Fed's reaction function. So the Fed previously very much focused on growth, focused on employment, and that was quite reassuring for equities because they knew that if there was ever going to be a downturn in the economy, then the Fed was going to be there to help. Now, what the Fed is shifting to, and I think we'll hear more about this next week, is more of a focus on tackling inflation. And as long as they're focused on that, then the market's going to get worried that even if there is some sort of economic downturn, then the Fed might press on regardless because it's worried about inflation. So I think the market is right to be digesting this news, right to be more volatile today. And I think we can expect these kind of dynamics to continue until we see inflation starting to fall from its highs, because that will give the Fed and the market reassurance that we can again start to look at growth and employment when we're setting economic policy.
Kiran, I want to circle back to the NASDAQ and the trade around that, because I know you're being asked by your clients what to do with tech names. And, there's a lot of debate. If you were in growth, had the profile for a reason, actually delivered some fairly steady and strong returns for investors versus value. It was cheap for a reason. What's the entry point? Are we getting anywhere near the stage where you'd say to investors, look, we've dropped 12+% on the NASDAQ from some of the 52-week highs. You're getting an entry point here that you may not get in future?
Yeah, well, I think it depends a lot on the time horizon. So when we've got clients who are thinking over 5, 10, or even longer term time horizons, then for them, then earnings growth is absolutely key. So that's what's going to really drive portfolio performance. So when we're looking at names in areas like artificial intelligence, big data, cybersecurity, we're expecting to see really strong earnings growth in these segments over the course of the next decade. And we think that if you do start to see volatility today, then that's already a good entry point to be building up those portfolios for the long term. Now, if you're a bit more of a shorter term investor, then you're going to be more exposed to changes in multiples, to Fed policy. And there we're talking with clients about getting a bit less exposed to those companies which are going to be dependent on interest rate policy. So that means moving a bit away from the secular names, a bit more towards some of the cyclicals, away from the large caps and more towards some of the mid caps within technology. And then more generally, shifting a bit away from technology if you've got excess exposure there and that's built up over time, and more towards some less interest rate sensitive sectors like energy, financials and healthcare, which are among our preferred sectors globally today.
Kiran, I've got to bring up the pandemic winners in the tech space after we've had such sizable moves in Peloton and also Netflix. I thought the market had really repriced around the pandemic trends, and we saw some of the heat really come out of some of these names, but it seems not. It wasn't enough when we're talking about double-digit declines. What do you make of the violence we are seeing in these stocks that everybody wanted to hold for a bit?
Yeah, well, I think there's a couple of things that are getting challenged in the market at the moment, and two ideas that have become quite prevalent after the pandemic. So one is the idea that we're all going to sort of stay at home, and that's going to transform work and leisure for the long term. And then the other is the idea that economic policy can stay loose and we can have very high fiscal spending, and that's not going to have major impacts. And that's now getting challenged, both of those ideas. So on the fiscal side and on the monetary policy side, high levels of inflation are challenging that notion, and that's why we're seeing the volatility in the market in general. And then if we look at some of these pandemic winners, then clearly what we're seeing from Netflix, from Peloton, is suggesting that some of the pace at which that work from home and leisure trend has been brought forward into analyst estimates may not be valid. Now, we think that trend still holds for the long term. We still think that general trend towards more flexible working, towards more digitalization, digital leisure, gaming, etc., that all holds. It just may not come as quickly as investors had thought following the COVID pandemic. So a bit like I said earlier, still a good trend for the long term, but short term, we're likely to see some volatility there, and we prefer to be in some of the more cyclical and value areas.